So here is the new video on the introductions of new sources of income and new taxes. So what are the objectives and contents of this new video? The aim is to introduce new source of income and new taxes. New source of income, so for example remittances, transfer from the state to households, transfers from the rest of the world to the state. This can be foreign aid. So also new taxes, for example taxes on value added and export taxes. So the list can be extended. You can add sources of income and taxes or subsidies that appear in the national accounts of the country you will study later. For example, transfers from the local country to the rest of the world. You can also introduce production subsidies or production taxes or subsidies for intermediate consumption. You will have to decide when you will study the national economy that you have selected. Obviously, we will have to introduce a new social accounting matrix, and we will end up with an assignment. We are therefore introducing a new source of income, international remittances or transfers of economies from migrant workers to local households. These transfers are introduced as a parameter. It is an exogenous variable which the modeler can modify outside the model. Since national income is defined as the remunerations of factors of production, including income from abroad, the equation for the formations of national income becomes INC must be equal to W multiplied by LS plus R multiplied by KS plus E multiplied by remittances. Indeed, these transfers are multiplied by the exchange rate, since they are denominated in foreign currency. These transfers must also be introduced in the current account. At this level, I will make a distinction between the balance of goods and services, called in our previous model trade sold, and the current balance. The goods and services balance records transactions in goods and services, hence exports and imports of goods and services. The current balance records transactions in goods and services and international transfers of income from labor and capital between residents and non-residents, and also remittances. The important point is that the macroeconomic balance includes the current account and not the balance of goods and services. So we create a new endogenous variable called CURR_ACC, and we also create a new equation where we define this current account as trade sold, that is to say the trade sold in goods and services, plus E multiplied by remittances. So remittances from the rest of the world to local households are added positively to the balance of goods and services, so it acts as an export of goods and services. This is because it results in an inflow of foreign currency. And of course, the macroeconomic balance is being modified to include the current account. Savings minus investment plus public sold is equal to the current account. We also introduce a new source of income, which is transfers from the state to households. So this is a new parameter called trans_G_HH. It is in fact also an exogenous variable, and it is part of the equation determining the disposable income. Disp_INC must be equal to 1 minus ITR multiplied by INC plus this new parameter. So indeed the difference between income and disposable income is the inclusions of income taxes, but also the inclusions of government's transfers. So this obviously affects the government's budget, which becomes the equations which is presented here, and which means public sold is equal to income tax plus indirect tax plus custom duties minus public consumption minus transfer from government to households. We also introduce another source of revenue for the government. These are the transfers from the rest of the world. This may be, for example, foreign aid. So this is a new parameter called trans_RM_G, and this is obviously an exogenous variable. It changes the equation describing the government's budget. So this equation becomes public sold is equal to transfers from the rest of the world to the government, plus income tax, plus indirect tax, plus custom duties, minus public consumption, minus transfer from government to households. So this parameter must be multiplied by the exchange rate because the modifications of this exchange rate modify the local value of this transfer. And it also affects the current account. It is a new inflow of foreign currency, so the current account equation becomes current account is equal to the balance in exports and imports of goods and services plus E multiplied by remittances plus E multiplied by this new parameter trans_Rm_G. New taxes are also being introduced, including a value-added tax. It is modeled here as a real tax on value added and not as a consumption tax. A new parameter is created. It is called TVA in sector I, and it is the tax rate on value added. It is an exogenous variable. This implies that there is now a difference between the cost of a unit of labor or a unit of capital for a company and what the worker or owner of the unit of capital receives. So, for example, in these equations, alpha multiplied by PVA multiplied by VA is the cost of capital for firms, and RKD is what is received by capital owners. Of course, it changes the budget of the government, which is now this equation, which means public sold is equal to transfer from the rest of the world to the government, plus income tax, plus indirect taxes on sales, plus custom duties, plus tax on value added, minus public consumption, minus transfer from government to households. Regarding calibration, there was no difficulty in calibrating the three previous parameters because they are identified in level in a specific cell of the social accounting matrix. Concerning tax on value added, we have the total amount collected, and this amount is combined in the social accounting matrix with the other taxes on sales in the cell of the columns productions of goods and services, agriculture, industry, services, and in the line public administration. I remind you that the amount of customs revenue on imports was already included in these cells. Therefore, during the calibration, the amount of tax on value added collected must be declared. So we declare a parameter, which I call TVA call in sector I, and which is the initial collections of VAT. And then, from this, we can calculate the value-added tax rates by the formula, which is indicated here. For export taxes, it is also necessary to declare a new parameter, which I call TE in sector I. It is the percentage rate of the export tax, and it is a new exogenous variable. This tax is part of the equation linking the local export price and the world export price. This equation is PX in sector I multiplied by 1 plus TE in sector I must be equal to the exchange rate multiplied by the world price in sector I PWX. I remind you that an export tax creates a gap between local and world prices, so that the local price of exports is lower than the world price, the difference making it possible to pay the tax. This obviously has an impact on the government's budget, so this is the new equations for the government's budget. It means public sold is equal to transfer from the rest of the world to the government, plus income tax, plus indirect taxes on sales, plus custom duties on imports, plus export taxes, plus tax on value added, minus public consumption, minus transfers from government to households. It's also necessary to declare the amount collected from these export taxes. So this is why I create a parameter export call in sector I, which is the initial amount of export taxes collected. This makes it possible to calculate the export tax rate by this formula. So this is the new social accounting matrix. I would like to note 4 points. First, remittances and transfer from the rest of the world to the government are in the rest of the world column in the rows households and public administration. Second, the transfer from the government to the households is in the column public administration in the row households. Third, in the column productions of goods and services, agriculture, industry, services, and in the row public administration, the amounts collected by the governments on value-added tax and export taxes are added to indirect consumption taxes and customs revenues on imports. And fourth, you can check that the total of each row is equal to the total of each corresponding column. So the list of new sources of income for economic agent and new sources of taxes and subsidies for the government can be extended. It must obviously be adapted to the economy that you will study. We can add, for example, production subsidies, intermediate consumption subsidies, subsidies for the purchase of capital good, new forms of transfers, and so on. I ask you to complete the following assignment from the model accessible on the platform, and of which the name is C2N2P2 engtrainees.gms. I'm asking you to compare two shocks. First, an augmentations by 100 of remittances, and second, an augmentations by 100 of transfers from the government to households. I would like you to have a specific look at production in volumes and how it is changed, and to explain the channel of transmission from these shocks to production. Of course, you must take into account the assumptions concerning the public closure, that is to say, public expenses adjust to let the public sold constant, and the foreign closure. This hypothesis is the exchange rate is fixed and the current account adjusts.